All right, today we're cracking open the investment case file on a financial giant that, kind of flies under the radar, Great-West Lifeco. We're digging into a really detailed analysis from Save, Invest, Compound to figure out what makes this quiet compounder tick. So is it a hidden gem, or are there some risks hiding just below the surface? Let's find out.
If you're an investor, you are definitely feeling the market's ups and downs lately. So the big question is, where do you find some stability, right? Could a massive, established company like Great-West Lifeco be the financial anchor you're looking for? Well, that's exactly what we're here to figure out.
So here's our game plan. First, we'll get to know our subject, Great-West Lifeco. Then we'll take a hard look at its defenses, its business model, and its competitive moat. After that, we're going to dig into the evidence, the hard financial numbers, and then we'll try to crack the code on its valuation. And finally, we'll deliver the verdict.
Okay, first things first, let's get properly introduced to our subject. Who exactly is this so-called quiet compounder?
Well, while its roots are planted firmly in Canada, make no mistake, Great-West Lifeco is a global powerhouse. Its influence stretches all the way across North America and deep into Europe, making it a really big player on the international stage.
So what do they actually do? Well, the business really stands on three main pillars. You've got life insurance, which is kind of their traditional foundation. Then there's retirement solutions, and that's a huge growth area, with aging populations. And finally, wealth management. You might even recognize some of their big names, like Canada Life and Empower.
Now, to really understand a company like this, you have to get this concept of insurance float. It's kind of the secret sauce of the insurance business. Think about it. They collect all our premium payments up front, and then they get to invest all that cash, the float, for their own profit, long before they actually have to pay out any claims. It's a seriously powerful engine for making money.
All right, on to part 2 of our investigation, understanding the company's defenses. We're going to look at its business blueprint and that all-important competitive moat.
Okay, this is where the story gets really juicy. On one hand, you've got a solid, durable moat that's protecting the business. But on the other hand, there's a big old red flag waving, negative free cash flow. This contrast right here is absolutely key to understanding the whole investment case.
So, what's this moat made of? Well, it all starts with their massive scale, which lets them spread out their costs and operate way more efficiently than smaller competitors. Then, you've got their huge distribution network, giving them incredible customer reach. Add in all the regulatory hurdles that keep newcomers out, and top it all off with really sticky customers who almost never switch providers. That is a powerful mix. Okay, it's time to follow the money. Section 3 is all about the evidence, the hard numbers that are going to tell us the real story of this company's financial health. This chart gives us a fantastic bird's-eye view. The balance sheet? It's rock solid, exceptionally strong. Profitability? Yeah, that's solid too. But then, we hit that snag again, weak cash flow. This right here is the central tension in the company's financial story. And when we say their financial footing is strong, we mean strong. We're talking about a war chest with over 193 billion Canadian dollars in cash. That is just a mountain of capital, providing incredible stability. You combine that with a totally reasonable debt-to-equity ratio of 42%, and you've got a company on very solid ground. But, and this is a big but, here's the flip side. This number, negative $5 billion, is their levered free cash flow. That's basically the cash left over after all the bills are paid. A negative number this big is a major concern. It suggests that even though they're bringing in cash, they might have less flexibility to do things investors love, like, hiking dividends or buying back stock. So this brings us to the all-important fourth section, valuation. We've seen the business, we've seen the financials, but what is Great-West Lifeco actually worth? Let's try to crack the code. So the analysis uses 2 different methods to figure out the company's true value. The first is a discounted cash flow model, which kind of peeks into the future, and that suggests a value of $68. The second one focuses more on earnings power and comes up with a value of $74. With the stock trading around $63.50, both of these methods are suggesting it's a little bit undervalued right now.
Now, before we see the whole breakdown, here it is, the final score from the weighted SWOT analysis, a 6.85 out of 10. That's a solid score for sure, but it's not perfect. So let's see how we got there.
And here's how they calculated that score. You'll notice the strengths, like that fortress of a balance sheet, they're weighted pretty heavily and scored high. But those weaknesses, especially that negative cash flow and external threats, like market volatility, well, they act as a drag on the overall score. It gives you a really clear picture of that tug of war between the company's positives and its negatives.
Now let's game out a few future possibilities. In a negative or bear scenario, the value could fall to around $55. The most likely base case is pegged right around $70. But in an optimistic bull scenario, where maybe interest rates go their way, the value could climb as high as $85.
This chart just sums up that whole risk-reward balance perfectly. The risk is scored at a moderate 5.8 out of 10, but the opportunity comes in a little higher at 6.7. So this suggests that while the risks are definitely real, the potential upside seems to have a slight edge. And that brings us to our final section. We've reviewed all the evidence. So what is the analyst's ultimate verdict on Great-West Lifeco?
So, what's the final call from Save, Invest, Compound? Well, it's very specific. At its current price of around $63, they're calling it a hold. But if the stock dips below $60, that's when they see a buy opportunity, giving investors a much better margin of safety.
Okay, let's close this case file with the key takeaways. What we have here is a stable, income-generating business that's riding some big, long-term demographic tailwinds. It looks a little undervalued, but the margin of safety isn't huge. That negative free cash flow, that's the #1 risk you gotta monitor. All in all, it shapes up as a potential defensive cornerstone for a long-term portfolio.
And that closes our file on Great-West Lifeco. So the question now is, what companies should we investigate next? Which stock's case file do you want us to crack open? Let us know your suggestions down in the comments. We'll see you for the next one.